Welcome, Stuart, to the R3 podcast. How are we doing?
Oh, Ben, it's good to speak to you. In the true COVID fashion, I'm actually isolating at home because Track and Trace have found me and told me I have to stay at home for 14 days. So this is a welcome break from that.
When does your quarantine period end?
Middle of this week, so not long now, and then I can be back out into the world.
Quarantine cake coming in. That could be
Yeah.
actually. So, as you know, part one of this episode focused on the meaning of a voluntary arrangement and why they are a good option for companies, small and large. This episode is like a follow-on, really, but with an exciting twist. The R3 standard COVID-19 CVA proposal. So I'm going to pretend I do not know anything about this standard and begin asking, as if I was a 3-year-old child, what is it and why do you think this type of standard proposal is needed?
Great. Well, if you open the standard form Word doc from the website, then I can talk you through that and explain why some of the clauses look as they do, and then perhaps you can get a good understanding of it.
Yeah, let me just open that up on one of my 5 screens. Just a second.
So while you're doing that, the purpose of the standard form CVA is really because, as you'll have heard in episode 1 of this podcast, the VAs are really useful, but because they're all bespoke, they tend to be too expensive for SMEs. So what we're trying to do is standardize it to an extent that enables SMEs to use it. Obviously, COVID is an incredibly unforeseen economic catastrophe, and it's going to hit on a number of SMEs that would never have contemplated any sort of insolvency process. And what this does is tries to allow them to get the benefit of a CVA when perhaps it would otherwise have been out of their price bracket. So it's drafted in a way that is a standard form and allows for information to be completed on the first operative page. There's some like blanks there and boxes.
Yeah.
And then for variations of it, either the standard form or the conditions to come in Appendix 2. And the reason it's done like that is because people are anticipating that there will be a large number of SME insolvencies. And if there are a large number of CVAs, what people like the revenue, for instance, will want to do is know what version of this is being used, or what it is, read it once, and then they can just go to the front page and Appendix 2, and then they can see how this differs to normal. And that's the bit they can then focus on, rather than having to read every proposal from start to finish as if it were a new thing. So that's why it's done like that. So I am sure there will be amendments to be made to the proposal by pretty much every case that there is, because it is a very generic one, and those will be in Appendix 2. So if we look at the basic standard form model, then you can see what that starts with, and people can start thinking about what changes they would want to make to it. But the first operative page, obviously you fill in the name of the company at the top, and it's a proposal by the directors of the company. So you'll know that a proposal can be made by administrators as well as a liquidator or the directors. So this is done as the directors one, on the basis that administrators and liquidators probably know what they're doing enough anyway that they can draft their own bespoke one if they want to. So we've then got nice big in bold bit saying these are a standard template and amendments are listed in Appendix 2. That is again just to make sure that we all know where we're at. So people reading it know they only need to read Appendix 2 once they've read all of this once. And then we've got the boxes that we fill in. Date of the proposal, nominees, length of breathing space period and stuff like that. All of this I shall go into later. But it basically just means that you can very quickly look to see what's going on there. One of the things you'll see towards the bottom of that box is referrer and connection to the company and referrer's payment. And that's because of new ethics rules and things like that say, to the extent you have a referrer and to the extent you're going to pay them anything, even if it's not for the referral but for other services, then you should tell everyone that. And of course, if you don't, and it's just someone that's come to you anyway, you can just say none. Are you still with me, Ben? That was just the introduction.
I am still with you.
I've not lost you. Not lost you yet.
Not lost me. I'm still scrolling.
So now we're on to
interpretation.
We're on clause 2 interpretation. This basically just pulls in the standard conditions. So the standard conditions are the other Word document you can find on the website. And they are very, very heavily amended by reference to the IVA standard conditions. So if you're from a firm that does lots of the IVA consumer ones, then you'll recognize them straight away. We've changed, person to company and things like that. But a comparison version showing the changes that have been made is also on the internet. So you can see what changes have been made to those conditions. And they're things like, how do you assess the level of the claims and what an unsecured creditor is and a secured creditor and a preferential creditor and things like that. So it kind of puts all the basics there that enable you to be able to run a VA successfully. So you've got that is now brought in by clause 2. So that's the base level sorted, and we can move on from that now to the body of the proposal. So introduction and background. Ben, as you're a very bright 3-year-old, there is a lot of information that you're required to tell people if you're proposing a VA, and that's set out in the law and in SIPs. And what this does is flag that and say in what appendix you will find it. So you've got a summary of financial information, appendix 4, employees, and a brief history of the company and things like that in 5. And this and obviously these are all going to be absolutely specific for each company. So you should definitely make sure that when you're drafting this, you spend a lot of time making sure this is right, because these are the other bits that the creditors that see a lot of these will be reading in detail. And we've been chatting, for instance, to the revenue about this quite a bit to make sure that they're going to be generally happy with what's going on. And one of the things that the revenue will expect to see in that is how compliant the company has been with its filing obligations to date. So, for instance, if it has been compliant throughout, and COVID's just one of those things that comes out of the woodwork and it's affected everyone badly, then they are going to be much more understanding than if the company has been massively uncompliant for years, and this is just another nail in the coffin. And to the extent that this is a VA proposed on that background, you're going to need to have a very good explanation as to why the company is now going to become compliant. Or I think you're going to see quite significant modifications being suggested by the revenue to make sure that things work properly. So we've got the background and everything like that and the appendices. And then we've got a nice simple description in 3.5 about where we're at. And of course, this has been drafted because of the COVID pandemic. It's really looking at those companies that would have been carrying on very successfully, trading profitably, but for the fact they've had to stop doing things for a while. So what this does is it recognize that and appreciate that they're going to need time to get themselves back on their feet. And then when they do get themselves back on their feet, they're still going to need time to pay everyone off. So what this does is gives a breathing space period when they don't pay anything, and then a payment period when they hope to pay a dividend of 100p in the pound to creditors.
That 100p in the pound, obviously that can be changed by whoever uses the standard form.
Yeah, and that's certainly one of the things that I expect will happen. There are companies out there that actually just need a bit of time to get themselves back going again.
Right, okay.
And there will be some that think they'll be able to do that and will propose 100p in the pound. And in 6 months' time, say when the breathing space period is over, they'll then look at it and go, you know what, we just can't do 100p in the pound. The new normal is now different. And the new normal means the most we can do is 75p or 50p or 10p or whatever it happens to be. And then they can propose a modification. There's nothing to stop the supervisor and the directors agreeing to go to the creditors and saying, can we please do something different and change this? But it might be from the outset, people just look at it and go, no, we need something different to this. Then they can put in appendix 2 that this isn't 100p in the pound dividend. It's going to be a blank p in the pound dividend and an explanation as to why, and that can then kind of be moved forward.
Glad you said that now, because I was worried listeners may hear 100% pound and then switch off.
Yeah, one of the difficulties you've got in trying to draft something that can fit everything is that, well, it never can. So this starts with the best measure you can think of, where everyone gets paid in full after a bit of a delay, but obviously that can be scaled back or scaled down. And for a similar reason, there is no special provision here for employees. If employees are owed money, it might be even, to the extent it's more than the preferential element, it might be that you need to pay them now rather than waiting, because otherwise they'll leave. So you might need to add a special provision for that. It might be you need to do something different with your landlord or landlords. And again, this proposal doesn't do that. So the idea is that this is a foundation document rather than a finalized proposal. So people can use this and bolt things onto it that make it work for the circumstances they're in. So we've got that as a hope that, hopefully one or two will use 100p in the pound, but we'll see. And then we've got to mention about the referrer at 3.6, which is just because we have to these days. And then in clause 4, you've got like the timescales I was talking about there.
Oh, so, the breathing space and the time period.
Right. And if you have a look at the middle of clause 4, so just after clause 4.6, there's like a timeline thing that uses a diagram to explain what I'm now going to try and put in words, because some people prefer diagrams, some people prefer words. And if you merge these two together, it might work because it's a bit complicated. So right at the very start, on the first operative page, there are some blanks to fill in for how long you want the breathing space period to be and how long you want the payment period to be. And what we've done in these examples is used a 6-month breathing space period and a 12-month payment period. I'll carry on using those periods for this chat just so that we've got something to use as an example, but they could be anything. It could be 3 months for a breathing space period and 24 months for a payment period. So we'll have to just see what people want or need in order to achieve that. So we've got the 12-month payment period, the 6-month breathing space period. But prior to that, we've got this concept of an introductory period, just to add loads of different timescales to your mind. And that's really to reflect the fact that whilst a lot of companies have now gone back to trading, some haven't yet. So the introductory period is just there to give a little bit of extra wriggle room if people aren't trading yet. And that lasts a maximum of 3 months.
Right, okay.
So if someone starts trading before that 3-month period is up, then that's when the breathing space period starts. And if they don't trade for another 4 or 5 months, the most it can last is 3 months. So at 3 months, the breathing space period starts. And if they're already trading anyway, then you can ignore this introductory period. So we'll assume it starts trading after 1 month. So you've got the approval is proposed. You've got a 1-month introductory period where no trading has started, and then they start trading. Hooray! The new normal is there. They get some money in. They can start to actually thrive again. And you've got 6 months of a breathing space period. And during that period, the CVA creditors, those that were owed debts at the time the proposal was approved, are not going to receive any money. So they're just held in the beds, a bit like a moratorium, because we started drafting this before the new moratorium had been created. So that creates this moratorium, gives the company time to get back on its feet, sort out what the new normal is, start to get some money flowing again, and start to get going as a business. And once the breathing space period is finished, what you can then do is start paying people. So you've then got a payment period, and we've suggested that's 12 months, but obviously that can be whatever you want. And that allows for regular monthly payments from the now trading company to the supervisor, and the supervisor can then assess creditor claims and make payments. It's really simple in that regard. Basically, it's just nothing happens for a few months, and then you start getting paid installment payments. As with all things like this, it gets more complicated once you start drafting something. And if you read the proposal, which I'm sure everyone will before they start suggesting it to someone, you'll see that there are nuances. Because one of the concerns we had is that what we don't want to do, for instance, is create a proposal that means that a debt that is due at some stage in the future, it will still be bound by the VA because it's a debt still. And we don't want that to suddenly be brought forward and have to be paid during the payment period. And here we're thinking about things like bounce back loans and stuff like that, where they don't have to pay anything for a year. What I don't want to do is after the 6-month breathing space period elapses, you have to start making contributions to pay the bounce back loan. That would add additional cash flow pressure to a company that doesn't need it.
Yeah.
So the way we try to deal with that is in clause 4.4.3. And these are future debts. And what it does is it delays having to pay those until the actual due date. And we've got some examples in there as well, just to show when these people will be paid and when they wouldn't. So the bounce back loan, if it's not due to be paid in the course of the breathing space period or payment period, then it doesn't get any payments. So it's bound by the VA, but as it's a future debt, it's not paid. It's also, of course, not released at the end of the VA. It's kind of a debt that will survive the VA because at the end, the company needs to pay it in its usual course. It gets a bit complicated if someone's owed money that needs to be paid partway through the VA, and this will require someone to get their spreadsheet out to work out when they need to add things to it. So let's imagine that it's a 12-month payment period and someone's got to pay 12 grand, but they don't need to pay 12 grand until 6 months into that payment period. What they then end up doing is paying 2 grand a month for the last 6 months rather than 1 grand a month for the whole year.
Right, okay.
Did that make sense?
Yes.
Oh, bro, you're a very, very bright 3-year-old.
I've read the CVA proposal.
But that's the point of that bit. It's basically just to make sure that people don't have to pay earlier than they need to. Because, I mean, obviously the point of this is trying to give people time to get to grips with what's going on. And then because we appreciate that supervisors of a VA don't just like magically get all their forms done and pay everyone immediately on receipt of the last distribution or dividend payment, you've got a completion period. And that completion period is 3 months from the end of the payment period. And that's just to tidy everything up, make your last payment and close down.
So in the completion period on 4.6, it says the completion period shall automatically extend until the HMRC debt has been agreed. What's the reason behind that bit?
So the difficulty that we've got is, of course, HMRC want to get paid their debt. And there are some parts of their debt that they cannot assess very quickly. So VAT and NICs and PAYE and stuff like that, they're done on a quarterly basis. You kind of know what they are and you can just pay them and carry on. Corporation tax can take a while to come through because you've got 9 months from the end of the accounting year to pay it. And weirdly, 12 months from the end of the accounting year to provide your tax return. So on the basis we're looking at a full CVA period that's going to be longer than that extra year anyway, it kind of means that the debtor company can get all of their returns in and get everything agreed. And then the taxman can get paid as part of the VA. But if there's an argument with the taxman, we just need to make sure it's all sorted before the final payment comes through. And realistically, the revenue will make this change to every VA unless we put it in. So this will basically mean that the supervisor holds on to some money until it knows it can pay the revenue because the claim's agreed, and then it pays it and closes down. I would hope that part of the course doesn't get enacted very often because you would expect it all to be agreed during the normal course anyway. You would hope.
You would hope, yes.
There is deferred debts. So one of the things you can do on the front page is list deferred debts. And that might be, for instance, debts owed to shareholders or directors' loan accounts where it's the director that's owed money. And it could be that you agree to defer those or the company agrees to defer those. And that means that those creditors will not get paid until everyone else has been paid. So that's 4.7. And 4.8 is one that obviously the directors will be focused upon as well, because what this says is that the directors won't be entitled to dividends or increase in their salaries until the VA has come through successfully. Obviously, if you're a creditor owed 100 grand and you're being bound into the VA and that VA says you're not going to get paid anything for a while, what you wouldn't want is to see the director buying himself a new Ferrari. So what this does is make sure the director just carries on having the normal salary stated in the appendix. And to the extent that the management do want greater salary because, in fact, they are doing really well, then obviously what they can do is just pay all the creditors off quickly. And if they can pay everyone more swiftly and bring the payment period to an end more rapidly, then that will obviously mean that the VA can conclude quicker, and it means that then they can give themselves a great bonus.
The dream.
So there are the usual sort of restrictions you would expect on a company trading in a VA in there as well. So they're not allowed to borrow during the period of trading within the CVA period unless it's on ordinary terms, unless the supervisor consents. And they have to carry on paying their ordinary trading sums as they fall due during the trading period, which is kind of similar to what new moratorium brings in as well. There are obligations to put management accounts out there to the supervisor so they can see what's going on. If you look down a little bit further, it says about trust assets. Because the company is going to be using all of its assets to trade, there aren't any trust asset, like a VA trust, unless it's actually the monthly payment that's being made by the company to the supervisor, which will form part of a VA trust. Because we're in a situation where no one really knows what's going on, what the future will hold, if there'll be a second wave or a third wave or a fourth wave, there is a little bit of flexibility built in at clause 5, which allows an extension of the breathing space period or payment period. So if the company requests it, then the supervisor may extend the breathing space period and or the payment period so that it's extended up to 6 months. So it could be that that the supervisor agrees to add 3 months onto the breathing space period and a further 3 months on the payment period, or 3 and 1 or 5 and 2. Well, no,
Okay,
it'd be 5 and 2 because 5 and 2
so,
is
so it's a combination of the breathing space period and the payment period. It has to total 6 months.
Yes. But if, let's say, they've breathing space period carried on as normal, and then it was okay, we're going to do a pay in full in 12 months. And then actually they've realized that, 4 months in, they still want to do 100p in the pound dividend, but it's going to take more than 12 months. It's going to be 18 months. So then the supervisor can extend it.
Okay.
And that would then make an 18-month payment period. So that will then work. So let's say they get to 15 months in and they go, we're doing really well. We are going to make these payments because we really want to. We want to be one of those companies that comes out of this having settled all debts, but we're going to need a bit more than 18 months. Can we push it out for another 3 or 4? And then what can happen is the company can go to the creditors committee, if there is a committee, to ask for a further extension. And again, that's up to 6 months. So that would then provide that a little bit of extra buffer. But if there isn't a committee or they want more than 6 months, then what you can do is go to the creditors as a whole and ask for a variation as you normally would. So it's just to try and build in some flexibility on that. Obviously, to the extent that what you want to do is a debt composition, which this proposal doesn't allow, when you want some flexibility there, then again, that might be something you would allow the committee to form a view on if you've got a committee.
So initially, the supervisor has the power just to extend the breathing space or the payment period for a total of no more than 6 months. But then if they want to seek more, then that's when the creditors committee or general body of creditors come into play.
Yeah. And it might be you get 6 months more from the supervisor, 6 months more from the committee, and then 6 months more from the creditors generally. Obviously, it's just cheaper and easier to get the committee to agree to a further 6 months than having to do a decision procedure with all creditors.
Yep.
I appreciate that it's rare to have a committee in the VAs anyway, but this might be a reason to have one. So then we've got trading. There are some restrictions on what the company can do when it's trading. And really, that's just to make sure that the value of the business and its assets doesn't depreciate particularly. So the company cannot sell, transfer, encumber, or otherwise dispose of its assets other than in the ordinary course, unless the supervisor gives his prior written consent. So that's clause 6 we're looking at now.
Yeah.
And obviously, the supervisor can get more information and approach the creditors committee or creditors for review if he or she wants to. And this is obviously just to ensure that the value stays there. Then it's 7, we've got what happens to hire purchase, lease finance and rental creditors, and for that matter, landlords in 8, and read the clauses and amend them to the extent you need to for the conditions of the situation that debtor's in. But the basic proposal is that any debt that existed at the time the proposal is approved is dealt with as with all the other debts. It's a delayed payment. But anything that accrues during the course of the VA proposal, well, then you've got to pay for that in the ordinary course. So you have to keep paying the landlord its full rent. So, for instance, to the extent you think that needs to be a turnover rent rather than whatever rent it says on the lease, then this doesn't achieve that. So you will need to have either a separate chat with the landlord or put it as a variation on the proposal. And then we've got the desirability of the proposal, which was quite an easy one to write, given that this is drafted as 100p in the pound dividend. But you should obviously need to consider, is it the right thing to do anyway? One of the bits you'll see in the guidance note, the formal guidance note that comes with this, is it doesn't replace the insolvency practitioner's obligations and to consider what is best for the company. And it might be that, in fact, if you're looking at it and going, well, there's no way 100p in the pound CVA will work, and in fact, we need to be significantly more violent than that, and we need to do more with the landlord. It might be you actually just look at it and go, what we need to do is some bilateral agreements with the landlord and a couple of the major creditors, and that's what we need to do. So all the IPs and the company's advisors generally will need to look to see, is a VA the right thing and is this the right thing? Because explaining why it's desirable if it's 100p in the pound is quite easy. But if it's not that, or if other things are happening, then obviously this is one of the things that will need to be changed.
Yep.
So then we've got distribution, clause 10, and this basically just gives an idea of what's going to happen. The nominee's fees get paid, the supervisor fees get paid, preferential creditors get paid, and then unsecured creditors whose debts are payable pursuant to clause 4.3.3, and those are the ones that aren't the future debts. So they're ones that have fallen due, not the bounce back loan that is yet to fall due. Did that make sense?
Yes.
Kind of.
Kind of, yes.
So
the 3-year-old
so
brain's coming into play now.
So obviously when we're paying a distribution, let's say you get your first monthly installment in month 1 of the payment plan, and the supervisor is really on it and wants to make a payment out to creditors straight away, then what we need to do is make sure that's being paid to those creditors whose debts have fallen due, not, for instance, the bounce back loan that's going to fall due later on.
Right. Okay. Yes.
So what that does is make sure that what you have to do is just consider those that have fallen due. If 10.4, there is a reference to interest, and it might be that the company is so confident it's going to do well, it will want to put an interest rate in. That's one of the boxes on the front page as well. I would be surprised if there are that many where the interest rate is anything other than 0, but at least putting it at 0 will make the directors realize that they are actually getting some benefit from proposing this, even if it is a pay in full, because otherwise, the creditors would get some interest that they're not getting. If we go on to 10.5, this is where the company's business or assets are sold. So you'll recall that earlier we said you're not allowed to sell anything without the supervisor's consent unless it's the ordinary course. So if you are selling it, what then happens? Well, what then happens is that money is used to pay the costs of trading that have been accumulated, because you'll remember they've got to pay for that as they're going along. And then it's used to pay CVA creditors. So that's the idea of that bit. Obviously, any secured creditors need to be paid off, and any tax chargeable on the sale needs to be paid as well. 10.6 and 10.7 are tax points, or actually when the tax man gets paid points. So if it is ordinary trading pay in full one where the company is going to make regular payments, and what the supervisor wants to do is on a relatively regular basis make payments out, because what we're trying to do is keep cash flowing through the economy, then what we don't really want to do is have to wait until all of the taxman's claims have been adjudicated upon before we make a payment, because corporation tax can take quite a long time to be calculated and agreed. And usually the taxman says, we don't want there to be any payment until all of our claims have been assessed. So what we're trying to do here is say, well, if it is an ordinary one where we are going to pay 100p in the pound and we're just going to get these installments in and pay them out, then you don't need to worry about having adjudicated upon corporation tax. You can pay in respect of the other taxes that have been assessed, and you can just keep the flow of money going, which is what the government hopefully wants to do. And that's 10.6. But to the extent that there's a failure in it, it terminates early, or it's the last payment that's going to be made, or it's a payment because the business has been sold, then obviously that's a different kettle of fish then, because the revenue needs to catch up. It needs to be allowed to claim for the full amount of its debt. Otherwise, it's just kind of left there at the end with nothing. So that then kind of pauses that distribution until the revenues claim has been adjudicated in full.
Okay, gotcha.
So that's 10.6 and 10.7. And then you've got the supervisor, how frequently the supervisor pays money out. So at 10.8. So 10.8, obviously the company is paying the supervisor every month. That's the plan anyway. The difficulty is that if the supervisor getting in this money every month, it might be completely impractical for him to pay the money out every month, because you might be writing out checks for £10.50. So what we've got is a level of flexibility for the supervisor to decide how often he or she wants to pay the money out. And we've suggested it's less economic to do so every 3 months, at least every 3 months. And one of the obligations you have when drafting a proposal is to say when you think dividends will be paid. So we have to put something in about it. So that's why that one's there.
Yeah, 3 months seems reasonable. Like you say, on a monthly basis, it's too much.
Yeah, it might be that you're getting £5 million a month in instalment payments, and then it is workable. But if you're getting 100 grand or 50 grand or 10 grand, then it probably wouldn't be. And obviously this is aimed at SMEs, so you're unlikely to be getting £5 million a month. So then we've got kind of the basic sort of ones at the end now, which are supervisors' powers and functions, which relate heavily to the conditions as well. There's a little bit extra there, 11.3, that says the supervisor will provide a proportionate report to creditors on the progress of the arrangement at the end of the breathing space period. And obviously anyone can amend this proposal and take that out if they want to in the appendix. So that's fine if you don't want to do that. I'm just thinking, if you're a creditor that's voluntarily said, I won't take any money for 6 months, at the end of that 6 months, I think you're going to be intrigued to know, is the company doing all right or not? It might be just like a simple email that goes to everyone saying, the breathing space period is now concluded. The company is broadly in line with its projections and intends to make all of the payments to achieve the proposal.
Okay. That makes sense.
Proportionate, but at least providing something so that people know what's going on. Then we've got the usual caveat: nominees and supervisors aren't making any reps or warranties. The company is. The nominees and supervisors' rem and expenses are set out in Appendix 6. Don't forget everyone to comply with SIP 9. Clause 15, you've got to explain what the avoidable transactions are. Obviously, if, for instance, there have been avoidable transactions, then what you would want to do is put a variation in Appendix 2 to say, whilst Clause 15.1 is amended to read, save for the transactions listed below, there have been none. And then you'd go, repayment of director's loan account of 100 grand 3 months ago, or whatever happens to be. Then we've got the EU regulation at Clause 16, which will stay in there for a bit, at least. And then you've got the director's declaration, which kind of explains that they know what is going on. And then the new version of the statement of truth, which says in even more detail that they can be done if they lie.
Yes.
And there you go. That's a stroll through the proposal. It's really basic because it's for SMEs and it's a standard form. And I think I've tried to highlight this as we've been going along. You do need to change it. It needs to actually change to work. But the idea of this is that it's something that is a foundation for which people can build upon. And, I know some IPs will use this as a way of saying to some creditors that we should be doing a bilateral agreement with you because you're really the person we need to sort this out with, but you're not engaging. So here's a draft VA that we're going to use to make you come to the table. And it can be used as a negotiation strategy to just wave it in people's faces and say, we're going to do a VA unless you come to the table and sort it out. So that's a useful purpose for this as well, as well as amending it up so it works for you and getting it out there.
Did you just think of that, or was that part of
No, actually, that's what an IP said to me. They think they were using it for more often. I hadn't thought of that. That's a really good idea.
We'll say it's your idea. I do follow, and like you say, the key is a foundation, and it can be amended or it can be used as a negotiating tool. I just have a couple of questions. So, has HMRC seen this standard?
They have. They've commented upon it, and we've tried to take on board their comments. I am hopeful that if the company has been a good compliant company to date, that the revenue shouldn't request variations to it. The concern, I think, is if it's anything other than that, then I think we'll see the usual standard variations coming back in. And I think it's going to take a while for everyone to learn what the new normal is and how we all need to behave. And I think there will be a large part of the insolvency industry, both legal IPs and HMRC, that are used to seeing companies fail with an element of culpability on the management, and sometimes very clear culpability on the management, so much so you want to sue them. But I think we'll see a lot of situations that arise now where the companies have been really well managed to date, and they could have been going for decades and earning lots of tax revenue for the government. And it's going to be getting our heads around the fact that there might actually be people there that deserve the benefit of the doubt and should be allowed to carry on in a VA like this that allows them to carry on managing with minimal supervision by the supervisor and get themselves back on track and back up again and paying everyone off and skipping off into the sunset.
Yeah, because like you say, as a profession, we see very SMEs that are struggling. Mm-hmm. But you say there's a lot of SMEs out there that have not been struggling prior to March, been suddenly hit by COVID-19, and then everything's been thrown up in the air.
Yeah. And that's what this is aimed at. A large collection of us have put a lot of time into getting this drafted in the hope that it can help some people keep their businesses and keep going. So I would urge people to think about it so that people can keep control of their businesses and keep making money for themselves and their families, and their employees can keep their jobs.
Certainly. I mean, it already seems it's more useful than the moratorium, shall we say?
Honestly.
But no, thank you very much, Stuart, for your time today, and look, thank you for the work you've put into producing the standard. Is there anything else you'd like to say about the proposal or the standards to the members?
No, other than to remember this isn't a panacea. It's one of the many tools that the IPs have to help a company. And it's probably not going to be useful for a large number of companies. It's only aimed at SMEs anyway, and it will always require some element of variation. Just know it's there as another tool for you to use, and hopefully it might be useful.
Cool. Well, thank you very much.
Thanks, Ben.